in the pod out there.
Hello? Does this microphone work? Now it does. Can you hear me? No? No?
Here, Amma is calling you.
All right. Bring that out here.
Mike's not on.
No, that mic's not on. Yes, it is, but it's not. Whatever. All right, let's get it going. I want to thank the 300 or 400 people here tonight. It is amazing, all these people that drove, and the few people that are at the house watching this online. So the 300 people, I don't know if you're passionate about multifamily or you're just damn crazy. But thank you for coming. We appreciate it very much, making the effort to come out. A lot of people have flown in from different places. I see in the audience, thank you, Tony. He's working on a purchase right now. And the team from Colliers is here. Thank you for making the effort to come on over. But again, we typically would have 250, 300 people at a night like tonight, but we only have, as I said, 300 people in the audience right now. So I think I would want to bring up James a little bit, and let's kind of talk a little bit about Old Capitol. We'll do a minute or two commercial, and then we'll get going with Greg Willett, because we just want to make sure that Greg is on time and we get out of here a little earlier than later. That works. Okay? So James, will you come on up and spend some time with us?
Give me 1 second. Let me see if I can get the slides going here. All right, there you go.
All right, we're gonna have James come up here and just spend a few minutes on our agenda for tonight.
Yeah, thanks, guys. So a couple things. I mean, obviously, you guys know we closed a lot of deals, so we're gonna run through a couple deals that we closed recently, talk about those deals, and then actually we had like 250 people registered, so we condensed that list of questions down to like 15 questions, and so we're gonna hit some of those questions as well before Greg comes up. So last year we did about 1.2 billion, 14,000 units is like 150, 160 loans. So appreciate all the business out there. So here's a couple of deals that closed in January, February of this year, all throughout the US. So whether it's Freddie SBL, recourse bank loans, non-recourse bridge, familiar with that deal. This seems to be the favorite of the first quarter so far, is non-recourse bridge. So you'll see a lot of transactions that went non-recourse bridge. This was one that actually went Fannie Freddie agency, and then this one, these last two were non-recourse bridge. So we'll actually gonna hit a couple of events that are coming up real quick, and then we'll get into the lender roundtable. So you want to touch on this one real quick, Paul?
So if you're an operator, you're a general partner, and you're responsible for the profitability of your company, is that JC Castillo and I kind of put together the operators roundtable. And that is for landlords to kind of become more efficient in the way they operate their properties. And so coming up March the 23rd, we have, and again, this is not for limited partners, this was for really general partners that own real estate. We have another segment on the operators roundtable about rehabbing properties. And so who's going to come in and join us is going to be Brian Amos and another gentleman named Michael Cagle. Michael Cagle works for Velo. He is in their design architectural piece of the deal, and he actually does the construction. His crew do the construction on the interiors of these multifamily properties. So he's going to give you some great insight about what's going on, what people should be looking at today if they're looking to rehab their property. So if you're thinking about going, you got to go into to this, and then you got to use a code called MAR 23 Roundtable. MAR 23 Roundtable, and that gets you the RSVP to come in and spend some time with us. Again, this is going to be a physical meeting. It's going to be over in Las Colinas, over in Valley Ranch. And it's going to be a lot of fun. We usually have about 45 to 50 people that are landlords there. Make sure if you have a chance to attend this event.
All right. So this is, so pre-COVID, we had done this event. This is our Hoops for Homelessness. This is actually March 26th, which is a Saturday. And this is for people who are in multifamily. So we usually have listing brokers, property managers compete 3-on-3 basketball tournament over at SMU. So this will not only let you get to meet listing brokers, but also compete with them in competition on the basketball court. So last year we raised about $15,000 for City House, and this year we're hoping to beat that number.
This is a wonderful and worthwhile event, and you'll be amazed if you can join us and put together this 3-on-3 basketball tournament. You got to get 4 people to play basketball. And we're trying to get Delaney this year to play. We're going to get a female basketball player. Fritz played a couple of years ago. Fritz, how crushing are these 3-on-3 teams? Very physical. So be ready. It is a lot of fun. And what's great about this is that you develop a relationship with some of the listing brokers and some of the vendors out there, and that it goes for a worthwhile cause. And again, the worthwhile cause, James, is for what?
This is City House. The City House is basically provides for homelessness, and it's really for kids like 0 to 18 that really don't have anywhere else to go, so they end up on the streets. And the City House actually has a couple different locations throughout DFW, and so they'll put them at these different like big houses, like my friend's house, and different places, and basically transition them from their current situation into the normal working world. So it's a great cause, and they actually rehab their whole center with the check that we gave them last time. So it's a great cause. So I think we have Chris Lee here with Brad's group. If you want to come up real quick, you had a couple slides just real quick about.
Am I one of the commercials?
Yeah.
Awesome, thank
So I think
you.
we'll start, if you want to just talk about the forecast.
Sure, well, if you could
One more?
yeah, that one would be great. Yeah, I'm just gonna speak quickly here. Hello, everybody, and thanks, James and Paul and Ryan and everybody at Old Capitol for putting this on and having us here. So one quick thing about basketball, the Hoops for the Homelessness, Paul said it's a lot of fun, and something that is a lot of fun is watching 5-year-olds playing basketball. Our twin boys are 5 years old, and we put them in basketball this year, and actually their last game is this Saturday. It is hilarious. I mean, they don't know which way is up. They don't know which way they're running. They don't know who they're guarding. They're guarding, members of their own team. It's a lot of fun. So, if you ever have an opportunity to go watch like any of your nieces or nephews or cousins or whatever play in little basketball, I would highly recommend it. It's quite entertaining. Okay, so moving on. And hello, everybody on Zoom. Thanks for joining us tonight. So why multifamily? We're all here for multifamily. And as you can see on the slide, there's 7 reasons to be all in. There's a lot of reasons, but there's 7 main reasons as why to be all in multifamily right now. And I can attest to you as well as just why I do it. I'm in deals. I'm a general partner in deals. I just closed on a property last December. Thank you, James, for all your help. Bridge loan. It was Sunset Heights in Fort Worth. And, right now it's such an interesting time in the industry. Purchase prices are going up. Rent increases are just continuing to grow. Occupancy is at an all-time high. And so this is the time. Like if you've thought about ever doing multifamily, or maybe you've been in it and you kind of, took your foot off the gas, like this is the time. And especially too, this is the last year for the tax advantages with the Biden administration changing everything, this is the last year to claim that. So just, you can take a screenshot of that if you want. Oh, number 5, there is a massive amount of capital available. There is so much awareness right now. There's so many people that are
എങ്കിൽ മെസ്സേജ്
aware of how
വാട്സ്ആപ്പ്
real estate
no, I
investment
didn't get it anything.
and
I didn't get
especially multifamily. And actually, I had a conversation the other day with somebody who was interested in this. They'd never done multifamily investing before, and they'd been looking at doing retail. And they said, well, what's better about multifamily versus retail? There's a lot of things, but one of the biggest things about that is that usually retail spaces have longer term leases for their tenants. So, you're as a tenant in a retail space, you may be signing like a 3-year lease or a 5-year lease. With multifamily, I mean, most of the leases are a year long. So when that year-long lease is up, you have the opportunity to increase your rents to market, drive up your value of your property. And that's another great way to, continue to increase your NOI on that property, which increasing the value on your property also helps with hedging against inflation, which, as we all know, is certainly occurring right now. And I'm not going to talk about interest rates because I feel really intimidated talking about interest rates at an Old Capital event when James and Paul are in the room. But, interest rates are slowly climbing, and that's all I'm going to say. So moving on, Brad Sumrock, I didn't even introduce myself. I'm Crystal Lee Thomas, and it's a terrible commercial. My name is Crystal Lee, and I am a student of Brad Sumrock. I also work for him and his wife, just helping with this education company that they have. And so Brad actually did a forecast last week, and he went into great detail on all of these points. So if you missed the forecast on the screen there, you can scan that QR code, or I have some flyers that you can grab from me that gives you information on this. You can go to our website as well, sumrock.com, www.sumrock.com. And the forecast, I mean, he goes into great detail on just all the reasons that I touched on, and also just talks about some of the projections that he sees coming up and his top markets. So we had over 3,000 people registered for that webinar, and it has just been so well received. So it's extremely time sensitive information, very critical information. So I'd highly recommend watching that. The next slide. So Rat Race to Retirement. This is an event that we typically do 3 times a year, but we are pivoting our business, and we are doing this event one time, and this is it in May. Yes, Charles, you heard me, one time. Rat Race to Retirement is only going to be one time this year. It is May 13th through the 15th. We have a bonus day on the 16th, and that's for platinum ticket holders. We have 3 different ticket levels. You can go to the website to see the different ticket levels. This event will sell out. We have in-person options and virtual options. So if you want to attend online, or I have Charles over here with show and tell, showing me his notebook, or you can attend in person. And this is going to be the event of the year. Again, we are only doing this one time, so please join us. It's always a fun event. We're going to have a special guest that we have yet to announce, and when we do, tickets are going to skyrocket. So thanks so much. Thanks for having us. Appreciate it. That's all I got. I have some flyers over there if you want to grab one. Thank you, guys.
All right, thanks, Crystal Lee. Gonna jump up there. So we had some questions come in from the audience, and maybe we have the Old Capital guys go up to the front and take a shot at some of these questions.
Oh, I'd love to see them take a shot at questions.
So, Ryan, Danny, Jay, up there. Oh, I will, don't worry.
All right, let's do that. Charles, come on
All right.
and sit in the seat, and we're gonna have James pop up here. So the first question is,
No, I'm good. I got it. It's working now. It's working. I was
Okay.
Trying to run the Zoom.
so the first question is really Fannie and Freddie, are they gonna be any more aggressive than the bridge lenders? And for that, we'll bring up our resident Fannie Mae expert, Fritz.
This is a softball question.
This is a softball question. But what we have to do is, for the softball questions, we have to bring up Delaney too. So Delaney, come on up here. What Delaney's new for the team. And come on up, Delaney. Let's see, I want to see you answer this question. We didn't think we were going to put you on the spot, but this is,
If you come down from Minneapolis, then.
she came down from Minneapolis, so I wanted to see her. Is there enough people here that want to give you money? So Fritz, what's the answer to the question?
The answer is I hope so. It's just been a challenging time for the agencies with purchase prices appreciating pretty quickly. You know, as you've seen the rent growth really accelerate, especially here in Dallas, we haven't yet seen that kind of flow through the actual P&Ls. So I'm pretty optimistic that as we get through Q1 and into Q2, you'll start seeing that rent growth come through and start being able to get some sort of proceeds. The issue that Fannie and Freddie have is they're cash flow lenders. And so that we can only underwrite in place income. So we're going to be constrained to that amount, which is why the loan dollars are significantly lower than a lot of the bridge lenders, where you can kind of look at pro forma underwriting. So that's why they're able to get to 65, 75% leverage when we're at, you know, in a lot of deals today, 55 and 50% leverage going in. So we've seen the deals that we're doing right now on the agency side are really deals that, you know, people bought last year and already have kind of gone through their renovation plan and are now ready to go to permanent financing.
Delaney, do you concur?
I concur. Thank you.
All right. Stay up here. There you go. Okay. So what's the, a lot of people at home cannot read that, so I'll read it for them. How is the lending market reacting to the Fed scheduling interest rate hikes? Which type of debt will this be impacting the most? So, Delaney. James, I'll let you handle this one.
Yeah, I mean.
Because James did a great job doing a YouTube video last week. How many people saw that YouTube video? Wasn't that good? We need
Hundreds.
I want to say hundreds of people saw it, but it was a great video.
So, yeah, I mean, with the Fed hiking, I mean, really it's that base rate, right? So as SOFR and LIBOR, a lot of the bridge loans are based off of that, or even a lot of the Fannie Freddie floaters that we have out on the market that we've done in the last couple of years. Their base rate on top of a spread is your all-in interest rate. So every month your interest rates are resetting. And so if the Fed keeps going, if they do 5 hikes, 10 hikes this year, then your interest rate could be, 2% higher in 12 to 18 months than what you're paying today. So I would say it's one of those things that everybody did fixed rate, then everyone had to pay yield maintenance penalties. So everyone went floating rate, and now the rates are going up. So it's bridge loans and floaters are the ones that it's going to impact the most.
Okay, any additional questions on that one? That's pretty straightforward. And Tony, who's doing a bridge loan right now on a property that he is acquiring over in Irving, is finding it right now about what's going on. And what are some of the things that you're finding on, Tony, in a bridge loan? What did you like and what didn't you like on a bridge loan?
I think what I liked is Hi, everybody. My name is Tony Lin. I'm actually from California, so Silicon Valley fluent today. So this is the first time doing non-recourse bridge. Definitely like the flexibility of it. We sold a property earlier in January, where we had to pay a pretty hefty prepayment penalty, something like north of 20-something%, right? Compared to a bridge loan, which is going to be more of like a 1% exit or 0.5% exit, right? So it gives you a lot of great flexibility. Maybe at year 3, we can refinance into a Fannie loan, okay, once we stabilize the property, right? So, but there's definitely comes with a lot of different restrictions, right? So one of the restriction is, you know, you will be regularly checked on the performance of the property, right? And if you're not performing to where they expect your debt yield to be, there could be cash management situations where they want to make sure they have additional income held back as a collateral, right? That's something that you're probably not going to have at Fannie Mae. There's going to be much more scrutiny on the operators, and as well as you know, your ability, you know, how much equity you actually put into the deal, right? So we've seen lately bridge lenders wanting to require about 10% or more. You know, so if you acquire a deal where your raise is 10 million, right? They probably want you to, you know, the sponsors to put in at least $1 million to show good faith, right? So there's also other cases where they want to set up like a cash sweep account, right? So where every month as the collections come in, it doesn't go directly into your operations account. It actually goes into account that's being held and owned by the bridge lender. And then every night they'll sweep that account into your operation account, right? And this is to protect them that in case if you ever fail to go below the performance metric, they can then just sweep that money into their basically their hard lockbox account, which is basically the additional collateral. So you know, it's great. I mean, I think we qualify for high 70s in terms of leverage, but we tend to be more conservative, so we ended up only taking 70% leverage on the bridge loan. But still, you know, it's in the current market, I think the quotes that we get from Fannie is 55% leverage, right? So there's definitely benefits, but there's a lot of gotchas. Make sure you talk to Paul about all the little different things that, you know, needs to be. That's where I find the most value with Paul and James, right? Who's able to guide us through a lot.
Thank you. Thank you, Tony Lynn, off the top of his head. Didn't have any practice with that. Dwayne, concur? Dwayne concurs. Very good. Let's go to the next question.
For sure.
Why are interest rates increasing and cap rates compressing at the same time?
You just pick anybody.
Ricardo. Why are cap rates compressing? Interest rates going up?
Good question.
Yeah.
Yeah, I mean, we're the biggest reason cap rates have still been compressing is I think supply and demand, right? So we've got a ton of capital. I think it was mentioned earlier about the amount of capital that's out there searching for deals, and we don't have enough inventory. So it's a supply demand issue. And I think the consensus is even with rates going up a little bit, or even if they do go up a point, the amount of demand that's out there, I mean, we don't see cap rates going up. At least I don't see cap rates moving up anytime soon. They may stabilize a little bit, but it's definitely a high demand environment.
I'll buy that. That sounds reasonable to me. James? What will happen when all the bridge loans for the last 2 years need to be refinanced? Ryan?
We'll call Fritz. Yeah, that's what'll happen. I mean, there's been a ton of organic rent growth in DFW, and if you know, things go as projected, then Fritz will be a happy man refinancing out all these deals, or they'll be sold. Happy general partners, limited partners. Anything to add?
James, what's
Yeah. Well, I mean,
what's your take?
what's really going to happen is probably all these deals are going to be sold, is what the listing brokers are going to want it. And a lot of these guys, if they're not able to refi off their bridge loan, they might have to go bridge to bridge, which we've talked to some bridge lenders who are comfortable doing that. But some of these guys might have to put in more equity into the deal, right? So if you took a higher leverage bridge loan and then you don't get the rents, let's say by month 24, then month 36, you probably need to either do an extension or take another bridge loan, or just sell the deal. So
They'll have to do something.
they have to do something,
They
yeah.
have to do something.
There's a bullet coming to their head.
So how do you avoid the bullet to your head, Paul?
Form.
Tobias asks, recommendations on transitioning from a bridge debt into agency. Recommendations. James, any recommendations?
Recommend calling Fritz.
Okay. And Delaney, all right.
Get Fritz on the phone and transition right into agency debt.
I think you talked about that.
Yeah, I mean, I think it really comes down to just the Fannie and Freddie are gonna look purely at cash flow. So they're gonna look for a 125 cover, and if you don't have it, then you're not gonna be doing an agency.
Yeah, if you didn't make a capital call today to get your leverage down, like Tony did, I mean, he raised a bunch of money. But if you didn't do it today and you can't get that loan refinanced to agency on year 3, you're gonna have a capital call then, if you still want to hold the property. So either you do it today or you do it 3 years from now. But hopefully rents continue to rise, cap rates continue to compress, interest rates stay the same, or perhaps go down. I mean, there's talk about them. We just had Pensford on the Old Capital podcast. They talked about interest rates, where the future lies with long-term 10-year treasuries. We think it's still very positive on that. But if you don't do it today, you'll have to do it. If those things don't work, you'll have to do it year 3. So question is how low are cap rates going and how high are interest rates going to go? And so the answer is, I don't really know. I don't know. I've done this for 36 years. I've closed 6,000 transactions. When I first started, interest rates were at 16, 17%. I didn't have the white hair like Charles has, but prime rate was at 21%. And so today, when you have interest rates and the 10-year treasuries at 2 or below, I mean, that's free money in my book. So even if interest rates were to go up to 2 or 3 or 4%, that's still free money as I see it. You just have to make the numbers work in the big picture of your specific transaction. So we're about to finish up here. How are the lending criteria in terms of expected change in the next year? So James did a real good piece. James Zhang did a real good piece on his video about what we're seeing. Again, 80 to 85% of the loans that we're doing are all bridge loans. So what is changing? Not so much in the Fannie Mae side, but what is changing in the bridge loans? And James, what's your take on that?
Yeah, I mean, we just had a conference up in Colorado, and we were talking with, so these bridge lenders work a little different. They package up the loans and then they sell them to Wall Street to investors. And then the way that they look at it, the investor basically says, all right, I'm willing to take on the risk of that loan for, let's say, 5% interest rate or 4% or 3%. And so there's so much liquidity in the market that those interest rates got driven down all of last year. So if you look at a January securitization versus a December securitization, what we started seeing though is that they were demanding higher and higher interest rates on that paper. And they started pushing back on some of these deals that were at 80% leverage. So it became harder and harder to securitize the paper. And so these bridge lenders now have that feedback from the market from the fourth quarter. And now in the first quarter, we're seeing a lot of lenders come back to 75% or 70% based on today's prices. So I think in terms of terms, you're going to see a little bit higher spread. So last year we saw stuff at 325, maybe 3.5 over SOFR. And this year we're seeing pretty much everything 3.5 to 4% on interest rate. And then your leverage at 70 to 75. So that's usually a good guideline to start underwriting your next deal. So we're gonna skip that one. This was my number one question. And so what is the best and worst loan structure for rising inflation and interest rate hikes? So Paul, you want to take that one?
Well, I think we've talked about the best structure is to try to get the lowest leverage possible.
If you can do it.
if you can do it. But because we all work in the syndication model, we try to get the highest leverage possible. So sometimes that doesn't work, but if you have small syndications or you have a controlling member that can sacrifice a yield to get lower leverage, that's gonna save you in the long run. But if we, our big thing is that we're thinking also too, is we have to be very sensitive about how people are operating properties. Because you can have the lowest leverage and you can have the interest rates rising, but if you are not operating your property most efficiently, then it doesn't make a difference if interest rates were higher or lower, the property is still gonna fail. If you're not putting money back into the property, you're gonna find yourself on a check with Fannie Mae, and you're gonna get a call or a letter at your house one day from Fannie Mae saying you have to put $500,000 into this property because you failed to put the money up into the deal, and you've just been distributing all that cash to the limited partners. So the collateral is the most important thing for the lenders. Make sure you maintain not only the relationship with the lender, but maintain the collateral to be the best that it can be. Anybody who doesn't make a different structure. Anybody who doesn't maintain the collateral is going to have a problem. James?
So I would sort of, so if you're looking for the best loan terms right now, I would say anything under really like $10 million. The first thing is probably Freddie SBL. If you can do a Freddie SBL loan and do a fixed rate and still get 65% on Freddie SBL, that is by far the safest because you can do a 5, 7, 10-year term. You can have a step down prepay and still get out of that loan in year 3 or year 4, and you still have enough time. What we're seeing though is a lot of non-recourse bridge lenders are not going down under 10 million anymore. So that's another change in the criteria is a lot of these guys that we were doing bridge loans with at 5 million, 7 million, 8 million, they're just gone. Like they're not doing those loans anymore. And so their minimums are starting at like $20 million. And so those bridge, they just don't have the capacity to do all these loans. And so under 10 million, Freddie SBL, or even we're starting to do like a lot of partial recourse bank loans. And those give you like a fixed rate. It might be a little bit lower leverage, but then you have an easy exit. It'll be a step down prepayment. And a lot of those you can do 5-year fixed on. So you don't have a bullet, you don't have a gun to your head in year 3. And so it gives you a little bit more flexibility. Above 10 million, pretty much you don't have a choice at this point. Pretty much unless you're putting 40% down, you're doing a non-recourse bridge. And it just depends on the leverage point that you want to go to. Well, yeah.
So one thing that I spent most of the day today and a lot of days on is really stress. If you're going to do a bridge loan, we've got to make sure that you're stressing your pro forma. And I think the question of what's the best loan, part of that is how comfortable are you with your pro forma, and how much margin of safety do you have, and your confidence you can hit that, because you got 2 things that could work against you: rates and cap rates, interest rates and cap rates. But if you're confident in your NOI growth, that can mitigate any issues going forward. So if you're going to do a bridge loan, make sure that you have a high level of confidence in your pro forma, or plan B is to go with a lower leverage agency deal. It's lower leverage, but it's very safe. So I think we spend a ton of time vetting that pro forma for a reason, because that is what's going to keep you safe.
And Delaney, you concur. All right, thanks everybody for coming up here. We're going to get to our guest speaker. This guest speaker needs no introduction, but I will introduce him to you. So this is Greg Willett. And so Greg, besides being a friend of ours, he just spent 20 years with RealPage over in Richardson, which is a high technology company. And he was our chief economist that just pretty much talked about apartments. And so Greg is the guy that whether you were a lender, a borrower, or somebody that had some influence on multifamily, you listen to Greg. Greg was is probably the most quoted person in the apartment industry when it comes to data and information. And people pay big bucks to listen to Greg and his forecast, in his his feeling about what's going on. So you'll learn a tremendous amount of information today from Greg. He has a great amount of slides, and I think hopefully he'll be able to share these with you after we're done, or James will push those out to you here. He just made the transition over to IPA. So IPA is Institutional Property Advisors, and it's a division of Marcus & Millichap, and they are the top of the cream of the crop when it comes to selling institutional type of properties. So not only does he do high-end apartments, but he talks about high-end apartments, but he also talks about the A's and the B's and the C properties. So and I'm certainly glad that Greg has shown up tonight with all of us, because he is extremely passionate about apartments, and he's a little crazy to drive in the weather we went through today too. So it's my pleasure to introduce a friend of ours, friend of Oak Capitals, Mr. Greg Willett.
That was a hard sell there.
So I'm happy to be here tonight, and rather than, given the group here, let's think of it, rather than a presentation by me, let's think of it as a conversation with me. So I want you guys to jump in and participate in the discussion. I'm going to talk, it says Texas apartments snapshot, but really I'm going to talk about US to give you some context of some of the things that are going on, as well as Texas, and a little bit maybe more on DFW than the other markets in Texas. And so I think that if you hear the media talking about the housing market right now and the apartment market, man, they're super focused on price increases, and those are obviously pretty stunning, but they seem to ignore the part of how did these price increases materialize. So I'm going to talk about that, and I'm going to begin the story with demand. We have a. You're gonna do it, okay? So demand story. So let's go back to pre-COVID. So we're in the first quarter of 2020, and we certainly hit a bump in the road, but have we recovered from that? Well, from that first quarter 2020 figure, the number of occupied apartments in the US is up by 1 million units. I mean, that is a stunning demand figure. And sometimes when I say that, people say that's impossible. But let me explain where that demand came from. There's two primary sources. First, when we hit COVID, you know, a lot of apartment renters are young adults. A lot of those young adults went home to live with mom and dad. If you go back to spring to early summer of 2020. So as the economy got better, they started to come out and form their own households again. At the same time, again, talk about young adults. College graduating class of 2020 did not go out and immediately rent apartments. They, again, mostly went home with mom and dad. And then they started to come back into the marketplace. And then you had another graduating class in 2021. So in 2021, we essentially pushed 3 waves of young adults out into the marketplace at once. So that created a lot of demand for young adults tend to rent the class B and C product. So that really generated some demand for that sort of product. And the other amazing thing that we had happen as we started to recover from the big layoffs that registered in spring of 2020 is we did a fantastic job of creating high wage positions. So if you look at currently the number of jobs in the US, we're still 2 to 3 million jobs below where we were pre-COVID. but in high-paying job categories, and Bureau of Labor Statistics, you can break that out. Particularly the high-paying job categories are professional services, financial activities, and information, and information is mainly tech. While overall, we're down by 2 to 3 million jobs, those high-paying job categories are up by 400 to 500,000 jobs. So we have all these, we've created all these high-paying positions. Obviously, you can form new households when you're adding people with those income levels. And so we have had a phenomenal run of renting in the Class A luxury product sector. So it's really where those people came from. Overall, let's talk about where did that demand show up by geography. Well, number one market is here in Dallas-Fort Worth. We've absorbed almost 70,000 apartment units from spring 2020 through the end of 2021. You're shaking your head. I mean, that's just a huge number. So 7 quarters, amazing. Number two, Houston. You can see Austin did well, San Antonio did well. These are all the metros where you absorbed at least 10,000 apartments. And what I'll kind of point out that maybe the media also hasn't picked up on is these gateway markets that really initially took a hit when COVID showed up, places like New York and Boston and DC and San Francisco and LA. Look at what's number 3. It's actually New York. So some of these gateway markets that stumbled have really made pretty big comebacks. So those are the absolute numbers. Let's switch it to percentage basis. I think this is interesting as well. So bottom axis, that's the absolute number. So again, you can see DFW and Houston way over on that side of the chart. Vertical axis here, we're talking about percentage of total inventory that's been absorbed in this last not quite 2 years. Look at Austin and Charlotte and Nashville. Those are just huge run-ups in those markets. But again, all of them are positive. Even New York and San Francisco actually have more apartment renters now than you did during the pre-COVID period. So that's a pretty amazing stat. So let's, the demand obviously is impressive. Let's talk about some of the things that we think about with the question of, hey, can that demand level continue? So again, the job change numbers are important. And as we've recovered, attempted to recover overall, again, for the country as a whole, we're still down 2 to 3 million jobs. But look at the markets in green. So those are the places where dark green, you've already completely regained all the jobs that you had pre-COVID. And you can see that's mainly in the Sun Belt and the Mountain Desert region where that's happening, versus you still have pretty big holes in places like New York, LA, the Bay Area, and Chicago. Putting those into absolute terms, James, let's go ahead to the next slide. You can see that the biggest recovery across the country is actually Salt Lake City, where the job count is up by 50,000 jobs or so, and we're about 4% above the pre-COVID number. About 3% above in Austin. Dallas-Fort Worth, we're about 1% above the pre-COVID level. As you look at these markets on here that are doing best, notice that Dallas-Fort Worth is 3 to 4 times the size of any of these other markets. So by far, Dallas is the biggest market that has made a complete recovery from pre-COVID times. And then again, you can see we've got raw numbers here. percentage change on the other one. And
Is Houston still sitting below? Still
Houston,
negative?
yeah, Houston still has not made it quite back over the numbers. And as we run through this, you're gonna see over and over again that Houston is doing really well compared to how Houston normally does, but it's still the laggard for Texas overall. So as we look into the coming year, for the US overall, we think that employment's going to grow 2.5% or so across the US. For DFW, Houston, and San Antonio, that should be 3 to 4% employment growth. And then Austin continuing to be off the charts with about 5% employment growth over the coming year. Let's now move on and talk about, I think we're talking about young adults. Aren't we talking about young adults? Next slide.
Yeah. Yeah.
Well, it'll get caught up. I'm going to talk about young adults. Obviously, a lot of renters are young adults, and so we've got here some graphics that depict growth in the population that's 20 to 34 years old, and the numbers are, again, in all of these markets, much better than what you see for the country as a whole historically. And then look at the expectations for the coming year, or the last block here is expected over the next 5 years, so 2021 through 2026. For the US as a whole, the young adult population basically will be flat versus growth of about 1% in that young adult population in DFW, Houston, and San Antonio. And again, Austin going to be a little bit better, close to 2% growth. So again, you add young adults, you create demand for apartments. And again, looking at the absolute numbers, DFW is in the lead. If you look at percentage change, it's going to be Austin by a pretty significant margin. Another thing that certainly contributes to apartment demand across Texas is these are still on a national scale, pretty affordable markets. Yes, ma'am.
So where do you see the intersection between youthfulness, young, and the higher paying jobs that you're talking about? Because earlier you're saying that the number of people going in are going to be renting, say like B and C plus properties, but in the higher paying jobs that increase like 400,000 to 500,000?
Yeah, it's a great question. So, and if you didn't hear it, it was talk about hey, we've done a great job of creating, getting some high demand for luxury apartments by creating well-paying jobs. Young adults usually don't have the highest paying jobs. And that's true overall, although something I will point out about some of the Texas markets is evolution of job quality. And particularly that is happening in Austin and in Dallas-Fort Worth, where you're young, you can still get a high paying job, but you're probably not going to make as much as you do when you're in those peak earning years. But as I talk to, again, my specialty is kind of the giant investment firms who are investing across the country. And the two things that they like about Texas now, and you're starting to see the big money companies that maybe weren't here in the past, the reason they're now coming to Texas, well, three reasons really. But one is increase in job quality, which they're looking for. Two is
run up in home prices, which we're going to get to in a minute. And the third one is regulatory environment. And I'll pick on Fritz like everybody else did. You're here from Minneapolis, St. Paul. What has just happened there?
Big time rent control.
So St. Paul just passed the most ridiculous rent control bill that has ever been approved in the US ever. And they're trying to figure out how to get out of this hole that they've managed to dig now. And Minneapolis is thinking about, they haven't voted for rent control, but they gave the city council power to do something if they want to, as I understand it, right? So you don't want to be in that sort of environment. And the assumption is that's less likely to happen in Texas. I won't say it won't happen, that it can't happen, but it would be harder to do. So that's one of the things. Those are three things that are driving money into the Texas markets overall. So here are the home price numbers. And I guess I have 2 points to make here. One being that, hey, yes, apartment rents are going up. Home prices are going up faster in most parts of the country. And then there's again, that difference between Dallas, Fort Worth, Houston, and San Antonio at 12, 13, 15 to 16% home price growth, and Austin at 29%. So again, helping support demand moving ahead. Home prices for demand for apartments moving ahead. Home prices have gotten much more expensive, and with interest rates going up, mortgages are getting more expensive as well. So, and it was interesting actually in the course of the past year. Usually in Texas, you're talking about, hey, what's the danger of losing people to home purchase? A lot of people took advantage of these huge increases in home prices and went ahead and sold, but now there's nothing for them to buy. So they actually bounced back into the renter pool for a while. So instead of losing people to home purchase, in some markets, you actually gained people. So again, looking at what has happened in home prices, and this goes back a little bit farther rather than just what happened over the past year. Look at what happened, go back to the previous cycle of when did home prices peak in the 2000s. It's a little bit different from market to market, but how much have they changed? Austin, you can see we're up 170% home prices relative to where we were an economic cycle ago. So again, that is going to encourage renting when it's so hard to buy at this point.
Why did Florida have such a hard time, or was it so high in 2005, 2006? I don't know. It's only up 20%. Seems like you just go buy all the houses there.
You certainly had when the housing bubble burst in the late 2000s, 2008, 2009, Florida really took it. So they were high, they dropped drastically, and then have come back up. Versus Texas, you barely had any sort of movement at all when the housing bubble burst in the late 2000s. All right, so kind of some big picture trends to think about across the US. Let's look a little bit more at the state of the housing market here in the Texas areas. And again, I'll start out with a national number. Okay, huge demand over the course of the past couple of years. Obviously, that means vacancy has come down, or flipping it, occupancy has gone up. We are now at a vacancy, normal vacancy for the US apartment market runs a hair above the 5% mark if you looked at what happened over the past 20 to 30 years. We are now at 3% vacancy for the country as a whole. The lowest number that has ever been recorded as far back as records go. Hey, I mean, you could have gone, it probably was a little bit lower immediately after World War II, but we can't really take the data back that far. So incredibly low. So around 3%, and you can see Austin and DFW are right at that national norm of 3%. San Antonio is a little bit higher than that. Houston is about 4%. So again, for Houston, 4% vacancy is stunningly low, but it is the laggard of the Texas markets. And so now let's talk about rent growth and what you're seeing across the country. And here's current pricing relative to the numbers that we going back to pre-COVID. As I'm looking at this, back up again for me.
Yeah.
Keep in mind, I have new people that are doing my charts. I sometimes don't know what they say. It says pre-recession, but it's really pre-COVID. So how much has pricing moved? Rent, how much have rents moved? I'll point out the dark green ones. Okay, that's rents are up 20% in the last 2 years. And you can see Southeast Florida specifically, incredible movement. The Texas market's up 15 to 20% for the most part. And so we've completely recovered everywhere except the red dot, and I think the only red dot is actually the Bay Area. So really significant movement across these markets. And so, yeah, here it is, measuring it by market. Phoenix and then Florida are in the lead. And you can see Austin and Dallas-Fort Worth somewhat above the national average. San Antonio a hair above the national average. Houston, as good as it is, actually hasn't done as well as the US as a whole on these rent movement numbers.
Greg, can you speak like 30 seconds on why Phoenix is just completely, like, nobody understands Phoenix, or it feels like Phoenix is moving twice as fast as even Austin? Like, what's the...
It is a market that has, also this, it has boom bust tendencies. So, I mean, it certainly, when things go well, things really go well in Phoenix. It managed to pick up a lot of people who left the West Coast and came to Phoenix because it was, by West Coast standards, a cheaper market. It's also a place that, as I talked about with Texas, you're getting a little bit of that evolution of job quality. It's getting a little bit better, but institutional capital, I will point out, still is scared of Phoenix job quality more so than they are in Texas.
Yeah.
It's moved a lot, but I'll also point out, as we said with Florida, in the last housing bust in the late 2000s, Phoenix and Las Vegas took the biggest hits across the country. So if you looked out across the entirety of that cycle, Phoenix is still going to be up there toward the top, but not certainly at the levels that have been seen over the last couple of years.
So what we saw is, like, the last 2 or 3 years, there was a lot of people, a lot of money that went into Phoenix, sold Phoenix after all this, And now all that money is coming to Dallas.
I would agree with that to some degree. I mean, there's still a lot of West Coast money that's going to Phoenix.
Sure, yeah.
All right, so again, rent growth, just last calendar year, Austin, 25%. I mean, that's a stunning number. DFW and San Antonio at 16 to 17% rent growth. Houston about 13%. And so I think this is super interesting. And I'm giving you the national number, but the pattern is the same in almost every metro. But it's unusual for Class A to be the leader in terms of rent growth. And you can see that right now for the US overall, about 16% rent growth in Class A properties. Again, Class A tends to trail because stabilized Class A has to compete with new supply that's coming online. A lot of times when you're leasing up brand new properties, you're going to have a period of free rents and concessions there. And so that capture ability to push rents and stabilize Class A properties, because you don't want to lose your renters to the brand new property across the street. So super unusual for Class A to be the best performing rent category here. And again, it comes back to, what did I talk about earlier? These high paying jobs that we've created. Vacancy for Class A product is much lower than it normally is. So they've been at the top. And let's talk about Class C a little bit. 7% rent growth. I mean, historically, that would be a really good number. It's not nearly what we see in other categories. But you have to think about affordability in this Class C product. And the folks who live in this product, a 7% rent hike is pretty substantial for the typical resident in that category of product. Before we got going here, we talked a little bit about inflation came up. Boy, inflation is bad news for these renters in Class C properties. That, I mean, just when their basic living expenses go up that much, it's a big deal. I mean, I filled up my tank on my way over here, and that was $73. If you're paying $73 for a tank of gas, that is meaningful if you're a Class C renter. So a little bit of a challenge there. And I also will say, I didn't put a slide on this. I worked with the National Multifamily Housing Council, which is an industry organization, that they had a project that began at the beginning of the recession, which was called the Rent Payment Tracker. And we were just looking, the technology companies were contributing data to see whether or not people were actually able to pay their rent. The numbers held up pretty well, but I will point out in Class C product, the number of people that are missing rent payments is actually starting to go up pretty meaningfully now. So a little bit of a caution if you're thinking about that Class C product for investment. There's some risk there that doesn't show up in higher classes of product. Move on to the next point. So as we talk about rent growth, how that's usually measured is what are you paying for a new renter moving into the property versus what was the price of that unit a year ago. Renewal leases where your existing lease reaches its expiration point, you decide to stay, and your rent goes up a certain amount, but it usually doesn't go up as much as that new resident number does. And it's still not going up as much, but it's going up 10% for the US as a whole. That's certainly by far the biggest number we've ever seen. And usually when you go above 5%, that starts to impact your turnover, net resident turnover numbers. But interestingly, right now, we've got 10% renewal lease rent growth and resident retention when leases expire is actually at an all-time high. So at this point, 10% is a bargain relative to if you went out and moved somewhere else in most places. All right, so let's talk about construction, which we're building a significant amount of product in the US. And I mean, we've had this phenomenal demand, but at the same time, there are about 700,000 market rate units under construction across the US. The number of completions this year will be right around the 400,000 unit mark. I mean, that's pretty substantial by historical standards. So if you look over the past year, Dallas-Fort Worth was the #1 building center in the US we delivered about 28,000 units here. Dallas has been the #1 building market throughout the course of the past decade or so, and #1 by a pretty big margin. And you can see pretty active in Houston and Austin as well. San Antonio didn't make the list of leaders, but we delivered about 5,000 units there. And that's actually kind of low by San Antonio standards. So developers are scrambling as fast as they can to try and get more product underway. We try to overbuild in Texas all the time. Let's go to the next chart, and we'll try again.
So real quick on this chart. So your absorption for DFW was like 65,000
over
year.
2 years.
Oh, it was over 2 years.
Yeah, but hey,
It made up for-
still, that's, you do 2 years worth of deliveries, and you're going to be 50 to 60,000. So it demands ahead, but not as far ahead. All right, so here is the amount of product that we are scheduled to deliver in the coming year. You can see Dallas-Fort Worth actually goes from 28,000 down to about 22,000. So that's a pretty significant pullback. And you've also going to trend a little bit lower in Houston and San Antonio versus Austin is going to go way up on the delivery number. But, as we look at all those, I mean, that's pretty absorbable relative to what we've done over the past few years. And so again, developers are trying, but it's tough to get those deals done. And certainly in Dallas-Fort Worth, what we're starting to see, even though it maybe makes the most sense to be building really aggressively here, suburban governments have gotten very uncooperative relative to where they were a few years ago. And it's just hard to get those projects across the approval line. So as we look ahead for the next couple of years, we do think that vacancy in these Texas markets will continue to be around the 3% mark during the next year. Go into the next slide. Rather than more forecasts, actually, I'm going to talk about sales activity. And as was mentioned earlier, man, a ton of capital out there seeking deals. And as we mentioned, a lot of reasons that people who used to invest in other markets actually want to come to Texas at this point. So pretty significant activity. You can see in all of these markets, the number of this is the number of properties that sold. We're right at all-time highs or just a hair above the past peaks. And then if you look at the value of what sold, last year. That's a stunning number in Dallas-Fort Worth. So we,
He did even higher than that,
yeah, I mean,
like-
the number of transactions in Dallas-Fort Worth went up a little bit, but we sold a bunch of trophy assets in Dallas-Fort Worth. And so it ended up being in dollar volume, the #1 market across the US by a huge margin over any other
So
location.
I see your asterisk. So that was only through third quarter. So if you throw
Well,
fourth
it
quarter,
was 12 months as of third quarter.
Right.
And I'm not sure why my team in Phoenix didn't actually give me your numbers because they're out there.
yeah, the
but,
fourth quarter was, I think, for year end, DFW was like 28 billion.
Yeah,
Yeah.
and yes, that is 12 months.
This is 12
But
months, yeah, yeah.
but fourth quarter specifically was an insane number in Dallas-Fort Worth, on the dollar volume of what traded. Yeah, you're right, because that tops out at 20, it was 28.
Yeah,
Yeah,
28.
for the year in total. So, again, are we gonna do that? No, that's the question. Can we do that again in 2022? I think we can do the transaction number.
Yeah, number.
But I don't know that the value is going to be as high as it was in this past year, again, because of those trophy assets that sold.
How was this last 8 weeks?
I don't have that at my fingertips. Obviously, in DFW, Class A was a huge deal because of all the institutional money that came into the marketplace. But again, I don't have that readily available. Let's go to the next point. So, hey, this is interesting. So here's the trend in price per door in product that's trading. And I guess my biggest takeaway here is that Texas traditionally has been thought of as a bargain sort of market. As all this capital has come in over recent years, that's not really the case as much anymore. If you go back a decade ago, the price per door in Texas tended to be about a third lower than the US norm. I'll point out now, DFW is pushing pretty close to that national average. And Austin has actually moved ahead of the national average on price per unit. So we're somewhat changing that math. The Texas markets are nowhere near Bay Area, New York, Los Angeles, but they are certainly have moved up to pretty close to the national norm. And again, as was mentioned earlier, cap rates still coming down with so much capital chasing the product in these markets. So the next handful of, let's go ahead. And actually, let's skip that one. Handful of thoughts for moving ahead. For the US as a whole, we do think that demand comes down this year relative to what we had last year. Again, young adults entering the marketplace. Again, we had, really roughly 3 years worth of grads coming out at once. So that's not going to be as strong. It'll be challenging to continue to produce these high paying jobs at the pace we had, simply because we have labor shortages. And in those high paying job categories, unemployment rates are down to around 4% in professional business services and in information, and it's like 2% in finance. So it's tough to hire in those categories. We do think that vacancy stays very low throughout 2022, and then begins to move a little bit more toward normal when we get to 2023. Expected rent growth comes down a little bit as well, but will still be high by compared to the historical norm. And again, hey, the last year was #1 by such a huge margin. You can cut that meaningfully, and it's still the second best performance that has been seen. Austin, we do think stays ahead of the pack in overall performance relative to the other markets in Texas. And then something wasn't mentioned here, but actually comes up a lot in industry conversation, this emerging build to rent single family sector that will certainly be growing in 2022 and moving forward as well. It's probably a little bit different demographic than the typical apartment renter household. Having said that, we just don't have enough of this product delivered yet that we truly know that for sure. So we think that it's, you know, it's significant enough that you can't completely ignore it, but it's not going to change the picture in a big way either. In terms of performance results, hey, maybe it happens what impacts what happens after the decimal point, but I don't think that it actually changes that overall first number. So something to look forward to on that front, and I think that's it. So,
We have some special questions for you from the
all right,
audience.
all right, awesome.
Well, we'll open it up here. You guys made the drive, so if you have any questions, definitely let's start here, and then I got some stuff.
You people online
Yeah,
have
we got
been
some questions.
participating?
Yeah.
All right. They have to wait till their turn.
Yeah, wait till turn,
Definitely,
yeah.
definitely.
No problem.
There we go.
Right, your forecast contemplate a recession.
Not for the next couple of years, but
If there were a recession, the forecast of growth hasn't considered that.
correct. And again, I will say that you know, we have an active Fed trying to reduce inflation at this point. Keep in mind that we haven't had significant inflation so long that even as old as I am, I was in high school the last time there was significant sort of inflation. So nobody who's dealing with has ever dealt with it before. So there's that question of what do you do? And even if you do what we've done in the past and try and go for that soft landing, the historical success rate at that is 0. So you know, I think it's more of a possibility than people have actually comprehended at this point, that we are going to have a disruption in the overall economy. We certainly don't want to end on that question.
No, that wasn't
Come over here.
Very solid. So your last bullet point on the previous slide was built to rent, and I was really curious what you were going to say about that, because I think that may be a big disruptor, but am I right in maybe summarizing, or you correct me if I'm wrong, that just it remains to be seen, it's too new, it's not formed into the market enough to really have anything?
Well, it's new in its current form. Let's back up to half of the renters in the US actually rent single family homes. They just rent homes that are owned by, for the most part, by individual people who might have a handful of homes versus institutional capital control single family rents are newer, although they've been around for a decade or so. And this, let's go build a rental single family subdivision, that's really new. And so the numbers that are available now are all over the place. That, you know, the two, what I would think the two places where you can source data that to me is sort of believable One of them says that about 25,000 rental single-family homes will come online this year, and the other one says 100,000 will come online this year. So I mean, that's a pretty significant difference. But I'll even go to the high end, 100,000. I told you 700,000 apartments are under construction. So is it going to become a factor? I think over time it can be, but it's not going to move the needle right away. And again, I want to have better understanding of the demographics who's going to rent that product before I really say too much about how that will impact things.
So kind of a follow-up to that. So then what I was curious about was you were saying that the vacancy number would kind of go back, stabilize, go back to before like in 2023, as well as pricing. So I was curious because like where are those people going to live? But it's because of increasing in deliveries.
We are going to increase, yeah, and there is an overall shortage of housing, both single family and apartments for the US right now. But we're actively building, we're building as fast as we can. And so, and partly there's, you're struggling with local legislation. I mean, it's a very anti-development environment in most places. There are supply chain issues that, I mean, I thought it was an interesting story in the Wall Street Journal this week. We have a whole block of houses that are done, except they don't have garage doors. So you're struggling with things like that to actually get the product out on the market. So can we fix it? No, we can't fix it because the real shortage is in lower price housing and you just can't build that. But over the next couple of years, the shortage should lessen to some degree. And hey, on vacancy in apartments, now it's 3%. If we went back to 5%, is that a problem? I think it's probably not in most cases. Yes, sir.
I was talking about really the major cities, but do you have any thoughts around secondary towns like Charlotte? Just have any thoughts about those areas in terms of rentals?
Hey, I'm not going to jump into specifics on some of these markets because I don't have those numbers in my fingertips. But I'm pretty active on LinkedIn. I'll share the story. So, and if you push information out on LinkedIn, Friday's kind of a wasted day in social media world. And so I thought it was like, hey, you don't want to put out your best content on Fridays. So I started and I just stuck a hashtag on it, called it Small Market Friday. and so every Friday for the past year or so, I've focused on a tertiary market, which means that I tend to think of that as there are fewer than 100,000 apartments in that market, but I've gone all the way down to like 20,000 apartments in some of these. And so and it's not true across the board, obviously, but generally what has happened is in a lot of these markets, you have not had construction, meaning very much construction in recent years. And some of them, you haven't had meaningful construction for a decade plus. So you've continued to add jobs at a slow and steady pace. And vacancy has gradually come down and come down and come down. And so most of these tertiary markets, you're completely out of product. And so we were talking about 3% vacancy here. There are a lot of secondary markets where you're down to 1% vacancy. And so rents have gone up. And so the question now is, are you finally at the point where you need to be doing some building in some of these secondary markets? And I think that's probably the case. So again, it's not a blanket endorsement, but a lot of these secondary and tertiary markets actually look pretty good at this point. Yes, sir.
So for your graph, you're showing on DFW in terms of amount of transactions as well as the amount of transaction dollars. So I always kind of thought and heard that during COVID, transactions went down significantly, but from your graph, it ended up like that was the case.
Transactions went down for 5 minutes.
One quarter.
Yeah, you really had one quarter where everybody kind of freaked out and
Everything
said,
came back.
and they were back by late third quarter to fourth quarter of 2020, and
By
then
summer.
2021 was just insane.
So that was my question. So what happened that caused the boom in 2021? It's been kind of okay during COVID. Why did so much transactions or so much dollars happen in 2021?
Well, the demand number, the renter demand number, the rent growth number, which went through the roof, and also, yeah, I mean, it's capital. I mean, it's like you want to place capital out there. Apartments and industrial were certainly the premium choices in real estate, and real estate was a safer choice than the stock market or pretty much anything else. So it was just, hey, you need to deploy capital. This is the top of the food chain at this point.
Yeah, and a lot of so in 2020, coming out of COVID, Fritz and Fannie Mae and Freddie Mac were the only lenders. And then 2021, all these bridge lenders came to the market. So it came not only from the debt side, but from the equity side. So when the equity came in and the debt, then everybody who made it through COVID, who wanted to sell in 2020, they couldn't sell because collections were all over the place. In 2021, they let it all go on the market. And especially we didn't even talk about taxes really, but a lot of people, there was a lot of rumbling.
There was
about
fear,
taxes.
there was
Yeah.
fear.
Yeah.
And
Yeah.
and hey, did that all really
Nothing happened.
change? Nothing, yeah. I will actually disagree with the commercial that came earlier. Taxes, nothing really happened.
Yeah, but the last year's bonus appreciation.
Right.
Yeah, nothing happened on the capital gain side, 1031 side. Yeah.
Thank you, Joe Manchin.
Did you recent data on collections, like bad debt? Is bad debt back to pre-COVID levels, or are we still struggling a little bit?
Just in terms of hey, are renters paying?
Yeah.
So again, I worked on this project with NMHC. The increase in missed payments for the professionally managed product overall was tiny. I mean, 1 to 2% above where it normally was, and kind of no impact at all in A and B, but Class C did struggle a little bit. And again, as I said, as we're looking at, and having said that, there are individual markets where there were problems. And the problem children on payments were New York, LA, Las Vegas, because so much of the employment is hospitality. And then New Orleans struggled. And then the couple of markets where it looked like people actually could have paid, but they didn't do it. That was Seattle and Portland. And so the Texas numbers were fine, did not really look any different than normal. And then the best paying markets in the US were actually Florida. Yes, sir.
Yeah, I have a question about Houston market. You said Houston has been slower than other Texas cities. And I saw the graph that has been built in the 60s. And I understand it was all shot, whatever, and also Harvey, but they came back up. But still, like guys, it's similar to San Antonio. But the population growth is there. Are there any other reason besides the hurricane and oil? Why Houston?
What I would say is Houston is a much more single family focused market. than the other markets in Texas. And so it's interesting, both supply and demand. Dallas-Fort Worth is the #1 market across the US by a drastic margin, but Houston is actually the #1 market for supply and demand in single family homes. And so it's just a little bit difference in the character of the population. And actually you can even see that here in Dallas-Fort Worth, that Fort Worth is more single family focused and Dallas is more multifamily focused.
What is your reason behind the softness in 2023 that you're predicting values and all? Given that,
Yeah.
DFW still has a flux of traffic, like, 300,000 moving in yearly. Why do you see that softness?
Well, I will share a secret about forecasting and economists. You over time just return to what the long-term average is in almost every model, because if I were to stand here and tell you that we're going to get 10 to 20% rent growth in Dallas-Fort Worth for the next 5 years, that's just a nuts thing to say. It's not impossible, but it's super, super, super unlikely that you can stay as heated as we have been over the last year or so.
So besides eating a chili cheeseburger after 9 o'clock, what keeps you up at night?
I got asked that in that multifamily executive article today. Did you see that? Are you stealing out of that? Do I have to keep my same answer? So I will say that there are, and I've kind of mentioned both of these things, and I'll circle back to your point. I think an answer to your question about a recession, I think that's more likely over the course of the next, say, 2-3 years than most people are thinking about. And then, but hey, that's a blip and that's fixable. The thing that really is of concern to me over the long run of how do we sustain this is the labor shortage. And that's not going away, and that's not fixable unless you actually significantly change the rules on immigration, which I think is something that we need to do and is going to be hard to do, but we're just not going to have enough working age people to sustain the sort of growth that we actually have become used to over the last couple of decades, unless we let more people into the country. Because if the other way to fix that is to have more babies, and that will fix it in 20 years, but it does not fix it in the short term. All right, come on,
You can go all night.
it's your call when we get to last
Two more,
call.
two more.
We'll take these two.
Two more.
Okay.
Nobody.
We don't see the salaries. How would you compare that? If you talk about 60, 70, 20% increase in rent, the renters are not able to handle that.
Yes and no on salaries going up. I mean, there actually is better wage growth now than we have seen in a very, very long time. But we are getting more segmented. Again, we're doing a great job of creating high-paying jobs. And another stat that I'll throw out there, in that Class A product segment, the annual income of the typical household signing a new lease for a Class A property in last year was, I'd say it was $92,000. So, I mean, there are a significant block of affluent renters. But to your point, where I think you were going is certainly in that clientele for Class C properties. They're Class B, I mean, maybe you're falling a little bit behind the historical numbers, but Class C, it's gonna be a struggle for those households. And real estate community can't fix this. I mean, there's a block of renters who just can't afford any of the housing that exists in the US. And if we don't actually build more affordable housing, that this situation is going to get more and more pronounced, and homelessness is going to get more and more pronounced. So, I mean, we got to think about that, but the real estate community alone can't fix that. And please have a more uplifting question for the last one.
Praise around. So I think in the last couple of years, we've seen a lot of equity coming from offices like hospitality, kind of flooding the multifamily market. Do you see that, continuing? I mean, do people now recognize multifamily as a preferred investment, or do you expect that, it will go back to being diversified among the commercial assets?
It's an interesting, I'm going to rephrase your question, but you really just asked is what happens with work from home or work from anywhere? Or do people actually go back to the office and we create the kind of economy that we had pre-COVID? And so my answer is, hey, somewhere in the middle. I mean, I don't think we go back to what it was, but at the same time, let me circle back to struggles in the economy that are related to we don't have enough people. I don't know what happens in the workplace where young workers need experienced people to drive them, and the experienced people don't want to go to the office anymore. So how is that going to come together? I think it's going to be challenging. But circling back to your point, hey, I'm a super fan of multifamily. I think it stays at the top of the stack for capital deployment, and is the safest bet of any of your options. So is it going to be as far ahead as it is versus other real estate types right now? Maybe not, but I still think it's going to be at the top. See, that was actually a good ending point, wasn't it?
It was a fantastic ending point. And so we appreciate Greg coming out and making the effort with the 275 people that showed up tonight that braved the winter weather, but we certainly do appreciate Greg Willett, our speaker and friend, making the effort. So thank you very much, Greg. It's great information. We'll push out, if we have permission, the slide deck and then his article that just came out in the Multifamily Executive Magazine that came out today, featuring Greg Willett. So
And you control the timing.
it was fantastic. Did a great job. These events don't happen by themselves. They're put together by our friend Les Meisel, Old Capital teammate over here. So we appreciate Les putting that together. Thank you very much. James, the professor, any additional things that we need to talk about before we say goodnight to everybody?
No, thank you. Thank you guys for coming. If you need any, we'll send out the slides, the recording, so if anyone missed anything, we'll send that out. And just be safe on your way home.
Sounds great.
Yeah, okay.
We're great. Thank you very much. Appreciate it.